Cool. Right there. That's it, Steve. Thank you. That was awesome, man. Like so much
Yeah,
good information.
yeah, that's about the best talk I think I've ever had. I've
Really,
done
that's
I've done
awesome.
a few of these with the heavy hitters, and that was one of the best. I mean, that was really fun. I enjoyed it.
All right, everybody, welcome back. I appreciate your time today. I've got a very, very special guest. Steve Burns is here, and we are going to jump right in. So, Steve, before we go at my specific questions that we were speaking about just a few minutes ago with the Darvis method and starting your blog and writing your books, could you just give maybe the one person who lives under a rock that's listening that doesn't know who you are? Could you give like a 50,000-foot view of you and your career and your experience in trading?
Yeah, my name is Steve Burns. I have been involved with the stock market really starting back as a teenager, looking at compound growth tables and how capital grows over time. And I thought, if I start this young enough, I can grow my capital to an astounding amount and I can retire at a very young age. So a lot of my life was optimized for financial independence and the stock market and trading, investing, and growing my money over the years until my money worked for me. And allowed me to not ever have to work again. So that's been my journey. I was more into investing in the 90s. I was a big investor in tech stock, tech mutual funds, and really thought that was the future. And I was had a lot of beginner's luck because that was in the 90s, a very good place and very good thing to do. I learned some hard lessons in March of 2000 as the incredible amount of money that I had made for me at the time. By the time I was 27, my account equaled what my house payoff was at 27 years old, but I had a 50% drawdown on that. And then I had to really learn a lot of lessons. And I was ready by the 2003, 2007 bull market to really have another run up compounding capital and making some good money. And this time I learned to get out of the market and go to cash in 2008 and shift to lower time frame. So I avoided the 2008 meltdown. And then since then, I've been focused on trend following systems and trading with an edge. So it's been an amazing, fun journey. Other people love sports. I've loved the stock market and trading all these years, and I've had quite an adventure, which I started sharing about 10 years ago online with followers.
Now, Holly is also a big piece of your business, right? Could you tell us a little bit about how she's involved?
Yeah, we've been married now for about 6 years. She is actually from the tech world. She actually worked at a software company when we
Wow,
met. And
that's
she had
cool.
some, yeah, half of New Trader U is Holly. She is the real writer. I'm just a trader. She's the one that translates my trading books into English. And,
Yep, I have
and,
Riley for the same thing. That's what we need him for, I
yes,
guess.
you're another team. It's amazing you have a business team like that. And she complements all my weaknesses with her strength. And she's
That's a
anything
perfect
tech.
partnership.
Yeah, she was a
Yeah,
web developer before. She worked for IBM. She was part of a train, learned
perfect,
how to eat. She's the one that
perfect.
was the e-course person because she worked with training and the first e-courses in some tech companies. So she retired as well a few years ago from her career. So yeah, we're just financially independent, and this is all we do full time is trade and share things and create things. It's really an enjoyable life.
And you've written like 17 books now, is that correct?
Yes, about 17 books.
Yeah,
I think it might be,
yeah.
I
So I
don't know,
mean,
more or less Spanish translations and other
I was
publishers.
gonna say a couple translations, a couple PDFs out there that I'm sure go along with. Right. So there's a lot out there, but 17 books is pretty impressive. But you said one thing that I do want to ask you about before we go a little bit for past that. In 2008, you said you switched to the lower time frame and you found that that helped you find success to get to cash, to get out of some of your what I would assume were bullish positions from 2003 to 2007. Is that correct?
Yes, yes. I did do some day trading. I turned into a day trader for about a year. I was not the best lifestyle choice that I've ever had. So for me, I did go back to more swing trading over multiple days and some, every now and then I'll still catch a trend for 3 or 4 weeks. But yeah, I definitely went to different time frames after the 2008 meltdown and learned some new lessons.
Was that because of volatility that like you
Yeah.
found that it was safer to be on a shorter time frame in and out kind of thing?
Yes, astounding. And my primary account, which I have my retirement account, which I really haven't touched much in the
Mhm.
last years, I've just compounded. And my taxable trading account did go to short time frames and some day trading, but primarily I went to cash in January of 2008. January 2008, I had a bunch of say went to cash and didn't start trading again in my retirement account till March of 2009. I started getting long signals again, but I
Wow.
did shift down in my actual taxable trading account and did some day trading and experimenting with different things with, like you said, volatility, intraday volatility.
And when you go back before 2008, and because that's where you said you applied a lot of the lessons you learned from the early 2000s, out of all of those lessons, traders always have like the cliche, like, oh, be patient, or, oh, follow my rules better. Was there anything in 2000 that really stuck out as you were like, this is my lesson and I am not going to repeat this mistake again? Was it just strictly to get to cash quicker? But like, what more maybe specifically could you tell us about that?
Yeah, it was drawdowns. You can't get
Drawdowns.
perma bullish. I definitely can't say the perma bears since 2000 now, but being since 2009, the perma bears thinking we're going to crash all the time. But there's also the perma bulls that, you have an opportunity. You've made a killing. The Nasdaq's 5,000 and you don't lock in all those profits and you start buying the downtrend and giving back money. It was really the downtrend and the string of losses. And I did not want to experience an equity drawdown like that again. And, I thought I was going to get back to even. And when I did, I was never going to give it back. And I did eventually get back to even around 2004, 2005.
And then you went forward from there. What did you do to prevent the drawdown from happening again? Was it add rules? Was it less risk?
Yeah, position sizing, trailing stops, having profit targets, locking in profits, not buying into down trends, knowing the difference between a pullback and a dip and a down trend, definitely not holding. I was a strong holder with, like the Bitcoiners are nowadays, high holding tech stocks and not thinking you're going to go higher. And it did work out really well, but it quit working around March 2000. And, I had to shift up. Yeah, but really risk management. If I'm not going to, I'm only trading to make money. If I'm not making money, why am I in trade?
Exactly. So, and I feel like that probably ties into the Darvis method and why it attracted you so much, because from what I've read about it, and that's very little compared to you, I'm sure, but it seems like it's a very bullish strategy. And a lot of people criticize it almost because they say it doesn't work in bear markets. So it seems like you kind of applied that right there. So when did you start the Darvis method? Was that during that time?
No, I actually read his book years later, around 2005-ish. I got into trading books. I started really educating myself after the 2002 time period. I read well over 400 investing and trading books from 2000 into 2010. For a decade, I just read almost trading book a week, every week, and was one of the top trading book reviewers on Amazon. And I kept seeing that book pop up, how I made $2 million in the stock market. First, like, that's the silliest thing I've ever heard. What a bunch of crap. I thought it was somebody living and some bull crap. So I ignored it so many times, and I started seeing it pop up on blog articles and people talking about it. It kept popping up as recommended. I read some of the reviews.
So you had to click it at some point. You're like, what am I missing?
I had to buy it and read it. It ended up being one of my favorite books of all time because it was a true story that was audited that a guy really did back in the olden times with telegrams and $100 commissions. So it really just changed me and affected my thought process.
The story of how he started that method is he was traveling around the country dancing. Is that true? And he was trading while he was traveling around the country?
Yeah, with telegrams internationally and calling brokers and sleeping through the trading day and only trading after the market closed. So it's one of the first trend followers in history. Really one of the very, very first ones, right up there close to where Richard Donchian started it.
How do you take a method like that? Because someone's going to ask you at some point, Steve, if it worked back then, how do you know it works now? What do you say to people that ask you that?
Yeah, and it works. It's very specific stocks it works on. It's not just, a universal thing for everything. It has to be, Darvis method, which also William J. O'Neill goes into the Cam Slim method, and even Jesse Livermore. It's a school of thought on trend following where only so many stocks in the stock market create the alpha for the rest of the stock market. That's why the indexes work. And if you have an Apple or a Monster Energy or an Amazon or a Tesla, that's what the Darvis method works on, not just anything. So that's something that has to be filtered to the right thing and the right bull market as well.
So when we see like whether you say we're in a recession now or not, that's not really the question. But when we see a pullback that we've seen over the last, let's just say 90 days, right? The last 3 months, the volatility plus the pullback, do you tend to turn away from trading in times like this just because it isn't that trending bull market that you'd like to see? You'd rather wait for that to come back?
Yeah, well, I have multiple systems. The Darvis methodology is one of many. I mean, I have a diversified signals and systems, just like I have diversified watch lists. Yeah, I mean, Darvis, his watch is basically the 52-week highs and the all-time highs is basically Darvis's watch list. And people don't know he did write about 5 other books, so he does go into more detail. and the publisher that actually they were out of copyright, out of publisher that actually republished all of his books. I'd reviewed them all on Amazon, so that's one of my first books I ever wrote was him asking me to write one. Like, man, you've read all of these books and you've traded for all these years. Why did you not write your own Darvis book? So that's what it really got me started in book writing. I thought, why me write a book on trading? Huh?
How did you overcome, I'm sure, because when you're a trader and then they tell you to go write a book, how did you make yourself comfortable with that?
Yeah, at first it's like a great idea. So, well, I love reading books, and that's the next logical step. One of my dreams, very young, was to write some books on success. Write books. I mean, I've read 1,000 nonfiction books. So, I mean, how many books can I read when I start writing? So, yeah, it was
Right,
a lot
right.
harder in reality than it sounds like. But yeah, the proof, because back then, the publisher paid for the proofreading and the grammar. Boy, I got chewed out by the proofreader, and I had to suffer through that. Holly, a little bit nicer, not a lot nicer, but a little bit nicer on the proofreading and editing and grammar part of
When you go through that and you sit down to write a book as a trader, what are some of the biggest issues that you came in? I mean, of course, like you and I probably are not the best sentence people to structure sentences or use proper grammar and things like that. But other than the grammar and the technical, did you ever struggle like generating ideas, or maybe how did you even come up with the ideas to go at each book? Because I remember when you and I originally started speaking a while ago on Twitter, I asked you, one of my first questions was like, do you have any advice for somebody that's trying to get a book on Amazon and write a book? You were like, yeah, don't write it until you've got the next couple planned. Now that's only advice that you can give me because it's in hindsight. So how did you push through and then like look back to realize that now?
Yeah, when I first, the Darvis book is something I was fascinated in. So, I mean, it's funny that it teaches you when you have to collect your thoughts, structure them, systematize them, write table of contents and write a structure. It really helps you learn more. It's like writing a term paper in college. So it does
Right.
help me. Some of my best trading happened after I wrote my first option book. My best option trading happened right after it. Some of my best years happened right after publishing a New Trade Rich Trade. It's funny how I learn as much from writing them, structuring and concrete, solidifying my thoughts. Making me put it on paper is a very good exercise to do. So it actually
A
helps me
lot
in
of
my
people say
trading
you
flow.
learn from teaching. A lot of
Yes.
people say that you can actually learn from teaching, learn from writing it down. So that makes a lot of sense. I feel the
Yeah,
same way.
one of the best ways to learn something is to teach yourself. Create a class teaching what you want to learn. That's one of the best things I use my ecosystem for is the deep diving I have to do, where things that I think I know in my head, but then when you have to explain it, it really solidifies what your thoughts
Totally
are, makes
different.
you learn. Yes,
It's
yes.
very different. Yeah, absolutely. Because, and I'm sure you could relate to this when you try to explain something that you really know well, like when you know it like the front and the back of your hand, you've been doing it for 5, 10 years, and you try to explain it to someone that knows nothing, you are like, wait, I just went way over your head. So let me just get somebody else to fill in this spot and they can tell you. Because if I try to talk to you, I'm just gonna, you know what I mean, talk you into 17 circles. Actually, what happened with me when I would explain to people what Forex was, I would just go too technical. I would blow them out of the water if they've never heard of Forex before because it's a relatively new thing on the retail side. So I would always have Riley come in and explain to people what it is. Now, I've gotten a lot better with it and I don't let Riley speak for me anymore in that sense. But at first, I could understand that where there is that barrier. So when you wrote these books, how do you put yourself in the reader's position to relate to the writing?
Yeah, my new Trader Richard book's one of the few. I just had a passion to write that after reading so many hundreds of books and going through all the mistakes and process and learning and successes and drawdowns and winning and I really had a passion to do that and it really helped me because I could be the new trader and the successful trader like what I learned and my most successes and it was like having the old me talking to the young me and being able to teach myself what I had learned and, through reading and experience. So yeah, it was a very cathartic process to do that and to actually summarize the 18 principles. Like, what's the 18 principles I'd slipped to myself at 17 years old and be able to solidify the book. That was one of my most enjoyable processes in trading to be able to do that. Like you said, have a narrative. That's what I found the New Trader Illustrator 1 and 2 was the narrative concept was may help people so much more than just, spitting out facts for 100
Why do
pages.
you think
So,
that is? Why do you think the
yeah.
information sticks better in that frame?
I think everybody, I had so many hundreds of messages I relate to it, the new trader thing, talking about the stress and trading too big and wanting to win and the drawdown and thinking it's easy money and not understanding you have
Sure.
to have a process and the reality of trading especially any kind of size, versus the theory of trading or the back testing or theoretically believing something versus putting real money at risk and losing real money and even making real money is a totally different process psychologically.
Definitely.
It's like playing a Madden NFL football, then going and getting an NFL game are two different situations, or shooting a target and shooting at somebody that's shooting at you is just totally different psychological process.
Way different. When you speak, I know a lot of your books, some are more tactical, some are more focused on that psychological aspect. What do you see new traders, because I'm sure you get a ton of messages more than me, what's the most common thing across any market that you see new traders struggling with?
Oh gosh, opinion versus quantification. People just want to believe something. They want to believe, oh, it's
they
time
want to
to
be
buy
right more than they want to make money, right?
Yeah, they think it's a predictive process versus a reactive process or a quantified process, and they think quants are some kind of magical beings, and they just think, and I think I know the future, I know what's going to happen, and if anybody knew, they think that's how it works. You're a predictor, you know what's going to happen. If you do that, you'd be a billionaire very, very quickly. And, very few traders are billionaires. I mean, it's a process of having a quantified system with an edge, trading it with discipline, with the right risk management. And, you have some big wins and some small losses, and you make money over time. That's what it really is.
The small losses, I think, is what throws people off too. And I remember you had one of the first posts that made me really see that, which I think you said the 4 ways your trade should end up, and one of them was a small loss. Most people end up holding on to those losers, I think, too long, especially a lot of new traders don't even trade with stop losses. But I feel like that all goes into that plan and that system. And you said that you have such a diverse system that it kind of allows you to stay adaptive no matter what condition the market is in. Is that correct?
Yeah, I want to be a swing. I mean, there'll be markets that go sideways. I have to swing trade. There'll be markets that go straight up. I'll have to trend trade, and I'm gonna let my signal. I try to structure my signals. Like coming off of this recent low, I had some 520 crossover signals in certain stocks that back tested well. So I took some 520 crossovers early on. It worked out really well. Then I started getting some 1050 crossovers. Those also back tested well in those stocks. I had some winners, some stopped out for small losses, but I had a great month because that was my plan. I wasn't trying to predict the bottom or call the bottom. I had quantified signals that would get me back in specific stocks when those signal and indexes when they triggered. And it worked out well. Just like in the meltdown, I got stopped out of things, and I got stopped out what I was in with trailing stops. My mate locked in some profits, and I got stopped out with losses. And then some the first dips didn't work where they bounced, but they reversed, and then the volatility escalated. And they just told me to go to cash and stay there. So I mean, it's just that's what trading really is, or at least for me.
No, that makes 100% sense. You actually have mentioned already today a lot of the other hedge fund big traders over, Jesse Livermore, Paul Tudor Jones that I was just talking about earlier to you. Like some of these big guys, you've studied a lot of them. Did the idea of having that system and that set of rules come from studying them, or did you see that elsewhere? Because some of those guys, their approach to risk is very, very different, but you've studied a lot of them. So where did that idea of finding a system come from?
Yeah, a lot of it come from several people that talk about Larry Height. I actually got to write a blurb for the back of his new book. That was
awesome.
A moment. And Ed Seykota, he's real buddies with Michael Covell, one of my friends. Ed Seykota. It's fascinating people at those levels where, I heard Ed Seykota gave a private coaching to a guy I knew on Facebook, and he started messaging me saying, "Hey man, I just had a coaching by Ed Seykota, which is one of my personal heroes, like the Yoda of trading legend." And he told him, buy Apple when it breaks out this many days. I don't remember exactly what it was. If an Apple breakout of a 20-day high or something, and then sell it when it goes below a 10-day low, something even longer than that. I thought, that's crazy. How could that be Ed Seykota's system? And then I thought it was crazy. I hate to disagree with Ed Seykota, but he didn't back test it. I don't understand how that works. And by God, that worked. He told me that before the big explosion in Apple a couple of years ago, and it's like, my gosh, that was a good trading strategy. And he doesn't even trade
wonder, what does he know?
He doesn't trade stocks.
Crazy.
He trades futures and commodities. And he come out with a system on top of his head.
That's nuts. But how do you think that is? That just being in tune with the markets? Like some of these guys are just naturals, like they're just born to do this, and that's why they reach that B and that T.
I think the one common variable I see with Paul Tudor Jones, Jesse Livermore, which he had his own psychological problems and risk management problems, position size, but with Larry Hyde, Ed Seykota, what I see in Paul Tudor, the common denominator is a risk reward ratio. If you have small losses and you have big wins or small wins and you have some giant wins every now and then, you're going to make money. That's what it comes down to, risk reward ratio. It's like a positive expectancy system. If you have a 50-50 win rate, if you just flipped a coin and you made $200 on heads and you lost $100 on tails, 2-for-1 risk reward ratio on a coin flip 50% of the time, you make money. And that's what it really all boils down to across all the other narrative and system building and quantifications. That's what it's about.
How do you play win rate into that? Because win rate plays a part of your expectancy, right? It's not just your 2-to-1, because like you just said, you can't do 2-to-1 in a 20% win rate strategy, right? So it has to kind of go hand in hand, and that paints the picture of expectancy overall, correct?
Yes, absolutely. You have to have the right, the bigger the outlying wins, the smaller your win rate has to be.
Of
But
course.
also the position sizing to survive, if you have, your win rate's also going to see what your losing streaks are going to be, depending on what your win rate is. So can you survive 5, 6, 7 losses in a row? So your position sizing has to let you survive your drawdowns and your losing streaks
Sure.
to get through it, to get to the big wins and the winning streaks, positive expectancy.
Right. I actually followed I follow a guy on Twitter, you probably do. His name is Sang Lucci, and he was the one that really gave me the idea of like, you have to know when your market is on and know when the market is off. And something that I kind of really internalized over the last year is being patient and being able to wait for higher quality setups. And part of that was being able to give language to setups that I could read risk reward, but weren't necessarily high quality setups because of other things that I saw technically. So for me, I've actually implemented a way of separating risk management in my mind, and I wanted to get your opinion on it. I've looked at it as two separate pieces. One being trade management, which is what you do while the trade is on, how you move your stop, how you close your position, how you adjust, like, and maybe whether it's working for you or against you. That would be like the trade management. But the decisions that you make before the trade, the size and the quality, I actually grade my trades. That I think it can almost be looked at as a separate bucket. Would you agree?
Yeah, I absolutely agree. It's like your risk reward ratio. When you enter, you enter your like you said, your trade entry. You have your risk reward ratio. What is the potential of your profit target, which you're open to? You could even have bigger than that. If it goes parabolic, you'll let it keep running with a trailing stop. You have your stop loss. Well, I'm going to admit I'm wrong here. I'm going to let it run to this is where I think my reward is. So my risk should be where my stop loss is. I'm going to position size so my percentage of loss in my account will keep me in the game if I have a losing streak of 5, 7, 10 losing streak, which will happen in almost every trading system there. And then, but that's your entry. Then, like you said, it's almost like you collapse the probabilities. Once you're in a trade, just like you buy an at the money option, it has a 50 delta. But as the option moves, your probabilities change and it gets more delta. If it goes in the money, the probability changes, plus your risk reward dynamic changes. If you enter an oversold market and it rallies to overbought, your risk reward ratio has shifted then. So you shift them over. But I completely agree. Trade management is one of the most important things you could do after your initial entry of risk reward ratio before you have your probabilities change while you're in a trade and you have to move your stop loss to a trailing stop. You have to say, my profit target's been hit. Is there a reason to get out? Is it showing a reversal here? Is it going into resistance? So I 100% agree with you. Those are the two steps.
I actually heard a really interesting concept this year, and I've been trying to work it into my system a little bit. I'm like slow with it because I want to test it, but the guy termed it as regressive risk. And basically what he was doing was saying, if I go in at a 10 lot and I have a stop loss in, I don't want to get hit at that stop loss with the full 10 lot position, basically. So what he's doing is he's found signals that he can build in to piece him out of the trade if it isn't working in his favor. Do you do anything like that, like regressive risk, or do you take the full stop, full stop?
I over time I have pyramided into winning trades during monster bull markets. It breaks the 200-day moving average, it keeps going, then you break the 50-day or 100-day moving that I had. I've done some pyramiding, not a lot. Mainly mine are in and out trades for the most part, but absolutely it's viable. I mean, I know some of the best traders I know use regret minimization frameworks where they're selling into a winner. They're exiting in stages out of a loser, and there are a lot of different stages where people trade half out if they're first reversal. They start worrying about it, or they're half out on their first profit target. So it's a regret minimization framework. It's really a psychological framework that helps you not regret as much. If it does keep running, you're going to have a piece on. If it does fall farther, you're already half out. So it's a good psychological framework. It's a valid. I don't use it very much except for pyramided into winners at times, but it's absolutely valid.
Do you find that pyramiding into those winners, those trades where you do get multiple confirmations and you can add in, do you see that being able to identify that is almost I would say not more valuable, but just as valuable as being able to know what trades you should not be in, where you might have an inclination in a direction, but then you see something that, you know what, this isn't exactly what I should see. Let me move over here.
I watch it, like you said, watch it very closely as it evolves. You know, if you have a strong bullish breakout of a first signal, whether it's a break back over a 30 RSI, I might say, okay, it's not oversold anymore. In reverse, I'm in. Okay, I got a 520 crossover. I'm going to add to it. Yeah, I mean, watching how it evolves, and it keeps you being, so you don't think you're a genius, you're going to nail it. You have some
Exactly, because
leeway.
then you're trying to forecast almost, but if you're watching it, you're reacting to it as it's progressing and as it's moving, not saying, oh, it's going to go parabolic. You would rather say it did go parabolic. And that probably goes into the same way you build your if-then statements for your trades as well, right? Where you're kind of planning out, if this happens, then I will react this way.
Yeah, exactly. That, especially if I'm trying to build a big position right after a bear market. That's what I had to do coming out of 2011 and 2009, where you do need to have the option of pyramiding into a winner, because when the bear market ends, that's one of the best times to make money in any market, after you've had a reversion to the mean and you're at more of a statistical historical value. And when it does come back, it's weird how the math works against you. If you're long something goes down 50%, you know, in a bear market, you're crushed. Like a stock goes down 50%, you have to have it double to get back to even. But if you buy when it reverses off the lows of 50% and it goes back to where it was, you're up 100%. I mean, you double.
Right.
So the math of the losses is so crazy when you really look at how much better you will do be on the right side of that math, and not letting yourself have a gigantic drawdown that you have to spend a long time digging out of. That's one of the most valuable lessons I ever learned the hard way.
And that was probably during that 2000 period, I would assume.
That was the first, yes.
So do you sit in the boat of a higher win rate and not needing as big of a risk reward ratio, or are you a Paul Tudor Jones, I want to win 1 out of 5 because it's going to win way bigger than anything else, I'm going to lose the other 4 small?
Yeah, I've always psychologically liked a 50 to 60% win rate. That's about, I do not feel comfortable with, I hate the losing streaks and I hate the 4 or 5 losses in a row.
too.
I do not like it psychologically. So I do better with a 50 to 60% win rate, which is about my historical norm, and about a 3-to-1 risk reward ratio that works out over time. And generally, on average, I have about a 2-for-1 reward to risk ratio for the most part. I might lose 2%, 3%, 4% of stock, but I might make 4%. 9%, 12% in the stock. But, you know, I do have, every now and then I'll have a dinger where I get hit for 10% down on a big fall individual stock. That's about the biggest I get. A 10% loss on a 10% position size, about a 1% total equity loss. So that's about my biggest dinger. Sure. But every now and then I'll have a 25, 30, 35% winner on some big speculative stock, and that really makes sometimes makes my year, makes my month. And so I love those big winners, but I do have some give backs with trailing stops. We're looking for those winners, but I love the big winners.
We're so similar. It's crazy, because for what I've moved into over the last few years is very, very similar, 50, 60% with about 2-to-1, 3-to-1. And I find that for the way I manage my trades now, once I'm up over 2-to-1, I'm normally locking my stop, closing some of the trade, and making sure I don't give anything back, just because of the volatility. And I find that people will come to me and they'll say, Austin, if you keep doing that and you keep getting stopped in profit, you're going to screw up your risk reward over time. Now, I'm not a mathematician, Steve. I dropped out of college, right? I couldn't pass accounting. But so I don't argue with the people to fight them and say, well, this is the math, this is the math. But what I do point to them and say is, look, it's been consistent for me, and that's the most important thing. But number two, what it's allowing me to do is it makes sure that psychologically I'm not taking more losses than I want to, where you're up in a trade and then it comes against you and you take that loss. That sucks. And by doing that, you know, closing some of the trade, locking the stop, and giving it space to continue, I'm able to take advantage of some of those huge rips like you're talking about. So how important is it to find, for some of the new guys that are listening to this on YouTube, and how do you guide them almost to say you need to find a system that fits who you are? Because you and I, like we just found out, are very similar, but some people are Paul Tudor Jones and they will take 6 losses for that 10-to-1 winner. You know what I'm saying?
Yeah, the psychology of trading, people underestimate that. Just like if you made a fortune as a lawyer, if you hated your job and hated going in and didn't like to talk to juries, you couldn't be a lawyer. Like a trader, the best trading system is the one you can follow with discipline that is psychologically comfortable enough for you to operate in. You can't trade if you don't like sitting at a screen for 8 hours a day. You know, you can't be a day trader. If you can't hold a position and you get too nervous, then you can't be a swing trader. You know, but you have to find what fits your personality. That's the thing is like I always tell everybody when they come at me, they have no idea what they're talking about. They're messaging me, and I say you have to find a quantified trading system with an edge that fits your personality and time frame that you can trade with discipline with the right position sizing over the long term. And that's it. That's successful trading. And a lot of it applies to investing systems as well. Warren Buffett does what he loves to do. Paul Tudor Jones does what he can do, and they're all billionaires, and they're almost completely parallel. Like Marty Schwartz was a day
Right.
trader and made a fortune day trading, and Jim Rogers was an investor, made a fortune investing, and both couldn't do what the other one does, and they're both billionaires, both wealthy.
In their own right. So you have to find what works for you. And for people, I guess, that are searching, you emphasize the quantitative aspect. This needs to have defined rules. This needs to have some testing. This needs to have substance to it, not just, oh, I'm trading at resistance, I'm going to sell it every time it hits resistance, right?
You have to have an edge. It's got to be either risk reward ratio is your edge, your size of wins are an edge, your even investors have some type of an edge in their investing with even Warren Buffett has a risk reward
Sure,
ratio and buys
sure.
certain discounted future cash flows. And you have a back tested system it worked in the past, so it has an edge. Back tested system doesn't guarantee it's going to work in the future, but if you think you
Of
have a
course.
system you want to trade and you back test and it doesn't work, then you're pretty darn 100% sure it's not going to work in the future. It didn't work in the past. There's no reason for it to. So you have to establish what is your edge. And if you
Yeah,
don't have an
absolutely.
edge, no amount of psychology and position sizing and risk management will help you if you do not have an edge to begin with.
But it's crazy because it's hard to find the edge, I feel like, especially in the crowded space of trading education on the internet. And a lot of it is so regurgitated, and it's almost like a lot of, sometimes I see bad information being spread around. But I feel like once you find the edge and you find a quantitative system and you can actually put it to work, then you get to the point exactly what you said, that you realize it is all in here. Like literally, once you have that quantitative system, you need to master yourself if you're going to make this, a 6, 7, 8 figure business in the long run. You can't do that. If you can't get the psychology up to par, I feel like you'll never reach your full potential. Do you agree?
It's like, yeah, Alexander Elder had the best thing in his book. He really taught me the three M's of trading: money management, mind, and method. And he says, trading has a three-legged stool. You have to manage your mind, your money, and your method. Any one of those missing, your stool will fall over. Like Richard
I
Dennis
like
said,
that.
he could. Richard Dennis said he could publish his rules in a newspaper. And Richard Dennis was before he had his big losses later on. He was worth over $100 million. A Turtles mentor, and he
Wow.
said he could publish all
Yeah,
of his
yeah.
rules in the newspaper, and it wouldn't matter because nobody could follow them, and they would give a drawdown and quit. I mean, and he's one of the greatest modern traders through the turtle system. And Jack
I bet you
Schwager
he's right
said,
though.
yeah, yeah,
Yeah,
oh
keep
yeah,
going.
because
Please, please, please.
yeah, I give people, I have systems in books that crush buy and hold, and most mutual fund managers can't be buy and hold, but who could follow it over the long term? Well, then Jack Schwager, I think Jack Schwager is one that said, there's endless ways to make money in the markets, but they're all hard to find. And even
See,
if you
it's
find
interesting
them, can
because
you use them?
yeah, yeah, and I feel like that feeds into that's human psychology, and that's kind of, I totally agree that you could publish a lot of systems. There are systems published. That's why even as I create content now and try to put out more stuff on the internet, I tell people like it's never just my way. I never want it to just be my way. Go find all of these other resources out there, but make sure they are quantitative. Make sure they are tested. When you studied all of those traders, what have you found? I know you said you already shared like the common characteristic that you've seen. What have you found seems to hold some of those big traders back? Marty, Paul, what holds them back, if anything?
Oh gosh, they still. I think a lot of them went on. Paul Tudor Jones still said after he was a billionaire, he spends every day, thinking everything he's done is wrong, and they stay humble. I remember one of the Marty Schwartz, so he made some killing in the market. I mean, just crazy returns, and he didn't lock in his profits. He just let it run, and the market closed, and it just dumped on him right at the end of the close, and he gave it all back.
Wow.
And so many,
Wow.
and almost every one of them, Nicholas Darvis, Alexander Elder, Jesse Livermore, even the ones that made millions, they all had at least a 50% drawdown, if not a blow up early on. Like they all had to learn that it's about a systematic process in the long term, and they don't know the future.
Are you in the boat that everybody has to blow up at least once? You got to blow an account. You got to take a 50% drawdown if you're going to become successful. Do you believe that's true?
I'm trying to think of anybody I know that didn't. I think Paul Tudor Jones was he's the best risk manager and the most consistent trader of the last 40 years. And even he almost had a cotton trade that destroyed him early on. Yeah, I
I
don't know
do
if there
remember
was
that was in
any.
his documentary. I
Yeah,
remember seeing about that. Yep.
that was almost the end of me. And I thought, do I want to be happier or do I want to try to be right? I don't think there's anybody I know that ever didn't have at least a 50% or blow up. So yeah, I would think it's almost, it doesn't have to be. I'm sure there'll be some young business person coming up that doesn't have the ego problems and does his homework and understands, somehow learns from other people's stories. But I've not heard of that person yet.
I have a theory it's going to be a woman, not a man. That's my theory.
It's a very good theory.
I think what's your opinion on that? Why do you think there's not a lot of female traders? Do you think that they're just turned off by like the alpha, the ego? They don't do things for money like men do?
Yeah, so Linda Roschke in her books, she sent me one of
She's
her
so famous.
Yeah, she sent me one of her newest books, Trading Sardines, that she self-published, and it's fascinating that she even said that, like, just women, it's just like sports. A lot of women, for whatever reason, just stereotypically, a lot of women don't like sports. A lot of women don't like the financial market. It's not their thing. They like other types of business and operations, just wired a little bit differently, probably physiologically. But that's what Linda
Sure.
Roschke herself, I just some women in business management said they themselves say it's not. Some women just don't like that. They're more nurturers and caregivers, and a lot of their times they're more intelligent. And they don't have the ego problems we have, and just over not stereotyping, but just my personal experience. So yeah, it's odd that a lot of women do not choose that course,
It
but
is.
they do outperform. I've seen studies where women traders outperform men.
Oh, absolutely. I filmed a Q&A video a couple of days ago when we were in Florida, and it just went up on my channel today. And I don't know the statistics, but I made a claim. I'm like, somebody who's listening, fact check me. But I believe that if you compared percentage wise, women to men, women would outperform men, but there's way more men that go into trading and try it and fail. So yeah, I mean that it makes sense. And I find that while the women can be nurturing and they have those characteristics, the ones that do come into trading like Linda, I think that they have skills that men have, that you would call it the same word, but they do it better. When you tell a woman to be disciplined and follow these rules, they're better at not letting ego come back in and act for them. They really follow the rules a lot better in my experience. Would you
Yeah,
agree?
seems like historically women don't have the same issues with asking for directions. Back in the 1980s, we had to stop and ask for directions. They had no trouble doing that, while men like want to find it themselves for whatever reason.
Right. But that is the ego of man, right? I mean, that'll be the death of man at some point probably too, because and then we'll have a whole world run by women because they'll all just make logical decisions while all of us are all trying to swallow our ego.
Must be the
But
testosterone or something.
exactly, yeah, that's exactly what it is. But as we're coming to the end of this, I wanted to just ask you one thing about your blog. Can you kind of share with us what inspired you to get on the internet and start talking about trading, and what, after that initial inspiration, what has kept you going to get it to the point where your numbers now are crazy?
Yeah, it's funny. I actually wrote a book first from a publisher that they said, hey, had the idea to write a book about the Darvas method because I've read them all and reviewed them all and had success with it. But it was 2011. A guy I knew, a friend I had, that he launched Around the Octagon. He was an MMA side. He did really well with it. He ended up selling it. I think he actually bought it back, and he was getting into dating back. What was it, 2010, 2011? And he was actually a day trader in the 2000s, but he said, I need to have a blog, a website. Why would I have a website? And he's like, you understand the opportunity in the website? And he kind of explained to me the opportunities, which, the 2000, it was incredible opportunities. People become wealthy creating websites. So he said, well, you need to share what you know. Blog, you would be, you write all these, I wrote all these reviews on Amazon for all these books. They're there. I have 1,000 reviews of books on Amazon that I wrote, trading and other things. He said, why
Sure.
don't you write on your own blog so it's your own material, your own content? And he
Right.
taught me
Right.
into it and built it for me and gave it to me. And I didn't quite get it. And, because I'm really big in the effort, spending your time wisely, getting return on your time and energy and effort. So I
Sure.
believe in it.
Sure.
So he taught me into it. That's how it started. And I actually started enjoying it and liking it. And because I'd already liked social media, I enjoyed going on, and I was Facebook friends with a lot of authors, trading authors and traders, because we'd email back and forth. So when I first signed up for Facebook, I found all these other traders. So that's where it all started. I got to be friends with them all on Facebook, and it blew up, and the blog started being popular, and it actually was cathartic, and I got to put my stuff down. So I went more from writing book reviews to my own blog, and that's how it all started. And it just grew. And I've always loved Facebook, and Twitter were my ideas for the most part, but the books and the blog and the e-core, that was all other people's ideas that told me I should do it, and I didn't really get it.
That's awesome.
So that was
I,
all
I
in.
I can relate to that completely. I had my first live seminar back in November, and I was not planning on doing it as soon as we did, but people wanted it. So it's like if the people demand it, if they tell you you're good at something, step into it, Steve. Take the blog. Let's go. You love writing. You love reading. Let's go. I feel like
Yep, I
that's
think
it. Spell it into your lab. And as you were answering that question, you got me thinking, and I think this is a really good final question for us to wrap up on here. So, as someone who has experience with, I wouldn't call them emerging markets, but new markets. You traded through the .com, through technology basically being developed. You were one of the first guys who was a trader on Facebook and Twitter, which is why you have such a massive community. You've been in it from the jump. So you've seen technology kind of grow. So you've seen the compounding effect of it, I'm sure. So when you look at markets that are new and upcoming, for example, cryptocurrency like Bitcoin, does that look to you, does cryptocurrency as a whole look to you similar to what the internet did in the early 2000s? Could this become its own whole market?
Yeah, I see a lot of correlation with the internet and people like all the .com era thinking the internet was going to change everything and the internet was going to be it was the same thing with the perma, uh, pets.com permables and, everybody thinking that, Amazon was going to change the future and etoys.com and all those, ones that went to zero and went bankrupt.
Right.
And it was like, and they were right. They were 20 years early, maybe at least 10 years early on a lot of them, but because Amazon was still at 70 back in like 2008, 2009. I mean,
Yep.
it went up
Yep.
and it went down 96, 97%. Then it was the winner. But it's the timing of it all. If you're right about something, your timing has to be right, or you might as well be wrong. And the internet people, the permabulls, were right. Me investing in all those tech companies were right. I did lock in a lot of my profits during my 50% drawdown, but
Mhm.
it's the timing. But like for a correlation to this, it could be that the blockchain technology is the breakthrough, like the internet was a breakthrough, not necessarily
Sure.
pets.com, not necessarily
Sure.
broadcast.com or Navigator. It's the blockchain and whatever, and whether Bitcoin doesn't seem to be scalable as a means of transaction. And if they
Right.
have whatever blockchain could eventually have a global currency that everybody accepts, that's valued against something else, and it could be the winner.
So
But
you would compare the
Bitcoin,
block to the internet.
that's what it looks like from what I understand about it. Not a crypto
Yeah.
expert, and
That
but
makes
both.
sense. No, that makes a lot of sense because then you would have Bitcoin as being one of these companies that could come and go, or it could be the Amazon and it comes and it goes forever. You know what I mean? We see the 100K, whatever it is. It's not like Bitcoin is the internet. Bitcoin is more like a company on that's a really good comparison, I feel like.
The other thing I don't, crypto, it's currencies. They're cryptocurrencies. They're not crypto companies. So the
Right.
growth
Right.
that comes from a company growing, if currency doesn't grow, even though there's a set amount of Bitcoins, they're lost and they're gone forever. And
Sure.
government can crush any moment. And it's not, you can't call Bitcoin.com if you lose all your money on
Right.
Bitcoin or they say, oh, you can't be stolen. Somebody put a gun to your head and they can make you transfer it and it's gone forever. So I don't
Right.
understand. That's like they are religious zealots for Bitcoin as if when the internet was, but somebody will win. I think there will be a global cryptocurrency, blockchain based, however it works, but it'll be more modern. The technology for Bitcoin may already be antiquated, and there may be something else coming. I thought Facebook had a pretty cool idea with what they were doing
With
in
Libra.
Ripple. Yeah, Libra
Oh,
was
and
a
Ripple.
great, yeah, Ripple of some very interesting ideas and see how it all washes out. But it'll be interesting if something will be one day like PayPal will be some kind of a crypto where everybody will accept it. It'll be backed by a trusted source. It'll be recoverable if they're lost, and it'll be fast and speedy access. And I think something will be big. I don't know if Bitcoin's that. It just doesn't seem to
Right.
me to be a functional means. And plus, it's not a company. It's a cryptocurrency. It's a fiat cryptocurrency. They say all the fiat currency is worthless by the governments. The U.S. dollar is backed by the U.S. government and the U.S. military. So it is backed by
Right.
something. Bitcoin's backed by nothing. So it is a
Right.
fiat cryptocurrency. So I don't understand the value, and I don't understand like you wouldn't be buying forex thinking the U.S. dollar is going to go to be worth a hundred
Right.
thousand yen. So
Right.
why do you think a
Right.
Bitcoin is going to be worth $100,000? I do not understand the valuation of a fiat crypto. I just don't understand it.
No, and that makes a lot of sense, honestly. Do you think that the comparison of Bitcoin to a company isn't, like you said, it's not accurate? Maybe Bitcoin to gold, would that be a little bit more accurate since they're both finite? And it's instead of just like you said, Bitcoin doesn't grow, gold doesn't grow, it just changes in value because of the market us because of us, basically, right?
Yeah, it's speculation. It's a pure 100% speculation with no underlying
Right.
intrinsic value, just like an option contract. You don't, the
Sure.
value is based on the utility and what somebody will pay for it. Bitcoin's worth 8,000 because somebody will give you 8,000 for a Bitcoin. And what's shocking to me, people think they'd be rich if they could have gotten Bitcoin early. So many of it's unregulated. So many of those, like, what is it, Mount Gov and other brokers were all frauds. And even if you would have got Bitcoin early, you still would have lost it all because it was a fraud for the
It's fraud,
brokerage.
right? It's scary. It's scary stuff. And then I made a video about this too. It kind of freaks me out a little bit when Paul Tudor Jones comes on the TV. They put it all over the mainstream media that he has 2% of his assets in Bitcoin. That's a couple $100 million for him, number one.
Mm-hmm.
But number two, I think that translates over to people on the main street, and they're saying, well, if Paul Tudor Jones is buying it, I got to get a hold of it. So I think that there's the people who look at it as like a hedge against inflation, like it could become gold. But then there's a lot of people that I think take your side of it, that it's like, this is just fiat crypto. Like this isn't anything new really, except for the fact, I guess they would say that it's decentralized. But if we are going into a technological age where they're going to have 5G everywhere scanning our faces, you're not even going to need your phone anymore, really. Why would we have cash? Like, are you going to, you know what I
Mm-hmm.
mean? If we're going into this technological world that everybody thinks that we are, it's very clear at this point, why would you even need cash? So it seems like at some point it has to go to a digital asset, that whether it's global or national, I don't know. But I think that I agree with you 100%. It will be some type of digital asset. Do you think that they'll convert cash to like a Fed coin, and it would be like your cash can be turned into Fed dollars, and then eventually over time there would just be no more cash?
Yeah, that would be fascinating, just like what Facebook was trying to do, and link it to a basket of currencies. That was pretty the best concept I've seen yet. But yeah, you're right that other countries could launch their own cryptocurrency but make it a much better user experience than Bitcoin. Uh, and what Paul Tudor Jones, he said clearly, it's a speculation. Paul Tudor
Yes.
Jones probably would have bought tulips in Holland and sold
Right.
them when they went up 25% and moved on with his
Right.
life. He wouldn't have been saying tulips are the future and tulips are going to
Sure.
$100,000. He might be buying Bitcoin. His exit strategy might be 10,000.
Right.
We don't
Right.
know that. That's why people can't
Right.
copy, because they don't know what position size is and don't know what the exit strategy is. He didn't say Bitcoin's the future and it's going to be 100,000. He said he's got,
100%.
yeah. So it's a trade. It's just a trade for him.
No, and that's a really, really good point too. And in a trade doesn't have any, like you said, he doesn't have a specific time frame on it or a specific profit target that he would want to see it go to. So it is very speculative. And you're right. I feel like even if big money does go into Bitcoin, if we're going to move into a digital asset, it's not going to just be Bitcoin. It's not going to be that one way to get, digital with your money. There's going to be multiple ways, you would think, especially if the blockchain becomes more mainstream. But no, that's really good information, Steve. I think that people are going to find a lot of value in that, because crypto's a touchy subject, you know what I mean? But when you can pull from so many resources and so many people's experiences that you've studied, I feel like you looking back on it now, I feel like even Peter Brandt, he's not a real big Bitcoin guy either. He's a real technical based trader like you. And I think he's not a long-term believer in it, but that doesn't mean I can't get in at 4 and out at 10K. You know what I mean?
Yeah, it's just a trade. It's just what other people value something at. Just like all the internet stocks, people made a lot of money. Dan Zanger made a fortune in the .com. He didn't say, I'm keeping pets.com. It's going to go to 100. It's the
Right,
future. He just,
right.
pet food, he just traded. It went up, doubled or tripled. He got out. He went on to the next trade. So that's what I think it is. But I don't understand the valuation, even as a trade. The speculative bubble of Bitcoin makes
Sure.
absolute no sense. Like the mining cost of electricity it takes to
Right,
mine
right.
them, but they're not
It
mining them
doesn't make sense.
forever, and
Right.
then they value it based on that. So we've already so many collapses, and so it reminds me so much of the perma bulls of the internet bubble, so much.
So no, and I totally agree. As we like I said, Steve, I really appreciate the time. I think people are going to love this video. To end us here with one last question. If you could give anybody that's new or just getting started in trading any advice with all of the experience that you've studied, what would you tell us?
Yeah, just slow down. The market's going to be there. Focus on compounding your capital over the long term with a quantified trading system that has an edge that you can trade with discipline. And that's what's a business. This is not an ego trip. This is not an opinion. This is not a crystal ball prediction factory. This is just math and a business of trading, selling something for more than you bought it.
I love it. Steve, where can everybody find you on the internet?
My website is New Trader U, the letter U, newtraderu.com, and I'm on Twitter at S Joseph Burns.
Cool. And I'm also going to put Steve's Amazon books in the description as well, so you guys can go check those out. I definitely recommend them. So Steve, thank you again, man. YouTube community, drop the comments down below. Let us know if there's anything you want to ask Steve directly. If you put a comment in, I'll be sure to hit it to him, and then maybe we'll have to bring him on for a second video. But thank you again, Steve. I really appreciate it, man.
Great talking to you, Austin.